Hey, this is Jim and Level 3 of the CFA program, the topic on ethical and professional standards, and the reading on an overview of the global investment performance standards. And this is part 2. Let me just quickly remind you that back in part 1, we looked at individual portfolios. Now in part 2, we're going to look at composites, and you'll see that in the learning outcome statements. I want to call your attention to LOS's 3 and 4 on this page. Let me go ahead and read these because I think it's important to distinguish between what we did in part 1, what we're doing in part 2, and then the likely questions that are going to show up on the exam. So look at that last black one. Discuss requirements of the GIPS standards with respect to return calculation methodologies. Now let me remind you that we went and calculated, remember we did an internal rate of return, or we did the Dietz methodology, and then we modified it, although I did inform you back in part 1 that there didn't seem to be any calculations for that modified internal rate of return. But we did lots of calculations, and there are calculations at the end of this reading. So it's my estimation that the LOS that says discuss the requirements also asks us and requires us to be able to do the math. Now, if you read the first red LOS, explain the requirements of the GIPS standards with respect to composite return calculations. That sounds an awful lot like the last one that I just read. However, although there is a mathematical problem inside of the reading, there is not one at the end of this reading in those 23 practice problems. Now we're going to go ahead and do the math here in this slide deck, just like we did back in part 1. So it's my recommendation that you know the math, even though the LOS doesn't say to calculate or compute. It's my recommendation to know the math, then you can discuss and explain. Oh boy, that was a lot there for an introductory conversation. Let me just quickly say, look back at the second one up at the top. There's the word discretion. So we're going to continue with some more discretionaries. We'll talk about composite construction and then the mandates and presentation, and then we'll end with a conversation on verification. So let's go ahead and do a little bit of a review, and then we'll extend it to composites. So what are we doing? We have these portfolios that are under management, and when we aggregate one or more of them, we call that a composite. And those composites then have to be identified to a similar strategy, a similar objective, or a similar mandate. So think of a composite as a portfolio of portfolios that are similar. Now those bottom 3 right angle boxes are probably really good exam questions. Remember, the Institute is really big on giving you a question stem in which there's a comment or a statement made by some analyst or a client. And so these 3 sentences here probably sound like really good potential exam questions. So first one, we need to include all actual meaning that you can't use a model, you can't use simulation. These have to be actual portfolios, right? Fee paying, and discretionary, meaning that the analyst, the investment manager, has discretion in where that capital flows. Non-discretionary segregated accounts and pooled funds must not be included in composites. I always just think of maybe an index fund. That would be non-discretionary. Whether it's segregated or not, that would be non-discretionary. And then non-fee paying discretionary accounts, they may be included, but you have to have an additional disclosure. And so I always think of my mother here. Suppose I'm managing my mother's portfolio and it's discretionary. My mother says, you know what, Jimmy, I love you so much. Here's all my money. You figure out what to do with it. And then I don't charge her. So I'm going to have an additional disclosure. So down at the bottom in a footnote, I'll say, my mother, she changed my diaper when I was little. She cleaned up all my vomit. And she didn't punish me too much when I was a bad little dude. And so I'm not going to charge her. I mean, that's kind of a silly an example, but you get the sense of what that means. All right, I think this is the most important part of this, the second half of this reading. So calculating the composite time-weighted return calculations. Now notice that the LOS just asks us to explain. We're going to show you how to calculate that so you can better explain. So we have this composite. What did I just describe it as? A portfolio of portfolios. So I want you to divide these three methods in the following manner. I want you to think of this first one as really just a simple weighted average. Remember how we computed the weighted average cost of capital all the way back? We did it level 1, we did it level 2. Weighted average cost of capital for a firm. We took the weight in the debt and the weight in the equity, and then we multiplied each of those by the required returns of debt and equity. So we weighted them. Now here, we're going to weight the assets by the beginning of period value. So this is going to be a really good question on the exam where the institute gives you the beginning of the period value and the end of the period value. Make sure you choose the beginning of the period value. Now, what the second method does is exactly the same as the first method, but what we're going to do is we're going to consider the external cash flows either into or out of the fund. And then the third method, we're going to go ahead and take a step back and we're going to say, you know what, let's treat the entire composite as if it were just one individual portfolio or actually one individual security. And that's called the aggregate return method. Now, what we're going to see is that these three methods are going to come up with a nearly identical number, not exactly identical, but what the Institute wants us to do is whichever one we pick, we need to make sure we explain it. And we need to tell everybody, hey, we're using this method, or this method. And so the Institute doesn't say which one that it prefers, but it wants us to make sure that we disclose it. So let's go ahead and work through an example. Remember, we're trying to explain in the LOS. So notice in those middle columns, we have portfolio A, B, and C. So over on the right column, we start with $150. And then A, B, and C have some intermediate cash flows, July 9th and July 20th. Notice that portfolio C doesn't have any of those extra cash flows. And there are ending values. So we start with 150, we end with 185.90. So the question then becomes, what is the composite return on A, B, and C? Now remember, what did I say in one of those earlier slides? That A, B, and C, they have to be similar in their mandate, in their strategy, in their objectives. So right, A, B, and C, maybe these are all three different portfolios that are mid-cap growth or something like that, right? All right, so in order to go ahead and compute the composite return, we need to go ahead and compute some individual statistics inside of each portfolio A, B, and C. Now, what we're doing here in the next couple of slides is we're going to do the calculations for portfolio A. Notice we have in boxed 5710 and then in ovaled in red 3333 and 3566. These are calculations that we did back in part 1. Remember when we did that modified Dietz calculation. So let me go ahead and just remind you how we do this. Oh, well, let's do the cash flow weighting factor first. So remember, we need to figure out the number of days. So there's that equation that we did, those weights. So we're going to say 31 minus 9 divided by 31. Well, let's just go back here. Remember in part 1, I was telling you about, memorizing which years have leap years. Well, I'm guessing that you guys know how many days are in a particular month. So there we start on June 30th. So to July 9th, that's 9 days. And then to July 31st, that's 31 days. So there you go. There's the 31 minus 9 divided by 31. And you get that weight as 0.71. So what you guys can do is you can just go and verify for yourselves, if you want, the 48 and the 35 for those other weights. Total beginning assets. Well, this was an easy one, right? For portfolio A, 50 over the 150. There's 33%. But then, remember, we did this modified Dietz equation in part 1. So then we need to do the same thing. So what we're going to do is we're going to take the 50, which we started with, and then plus we're going to weight the cash flow. Here, let me just go back here quickly. So we get the $10 in the cash flow, multiply that by the 71 because, well, that was the 9 days right in July. So there's the Where is that? That's the 5710. So that relative weight plus the weighted cash flow is 57 over 160. So that's 3566. So let me just go back here. So look at the bottom two rows. There's the regular old simple beginning of the period 33%, and then there's the a little bit more sophisticated weighting scheme of 3566. And you guys can go ahead and take some time if you want to compute those bottom two right boxes, the 2667 and the 2688, if you want to do that. But of course, notice the bottom right there, they've got to sum to 100%. All right, so let's take a deep breath and ask ourselves the question, how are we going to compute the composite return? So we'll do this first method, the beginning assets weighting method. And there's a good old formula in the light purple box. And this is super simple. So all we're going to do, this is what I was saying about that weighted average cost of capital. So we're going to do 33% and the 26% and the 40%. Those are the weights for portfolio A, B, and C, and then we're just going to multiply those by the return for the month of July. Now, we didn't give this to you until this particular slide, but notice on the far right column over there, those are the modified Dietz returns. So let's just go back here for that 911. Do you want to calculate that 911? Do you guys remember how to do this? So we start with 50, and there's the 6520. So in the numerator, we're going to do the 6520, and we're going to take out the 10, and we're going to take out the 50. So what is that? What's 65 minus 60? So that's what, 520 in the numerator. And then in the denominator, we're going to start with the 50 plus that 710 that we calculated. So what's 920 over 5710? So that's going to give you the, where am I here? That'll give you the 911%. So that's the modified Dietz. Now be careful. The institute on the exam in that return column over there in the far right, they could give it to you as the internal rate of return, right? They could give it to you as we do here as the modified Dietz. Or they could give it to you as the modified internal rate of return. Now, let's take a deep breath. You might have to calculate the IRR for portfolio A. You might have to calculate the modified Dietz for portfolio A. But the Institute never, in the body of the reading or end of reading questions, asked you to calculate the modified internal rate of return. I really don't know what I'm saying. I guess I'm saying is just make sure you know all the calculations. But this one is super simple, so you get about 15%. All right, let's do the beginning assets plus. Let's weight the cash flows. And we're going to go ahead and do just this simple formulation. All we're going to do is take those percentages in the middle. So the 3566 and the 2688 and the 3747, multiply them by the exact same modified Dietz returns, and we get, well, nearly 15%, but it's less, right? It's 14.61. Now, I want to take a step back here and say to you guys, all right, this is what you could be thinking. You could be thinking, wait a minute, in the modified Dietz, we went and computed the weighted cash flows for the individual portfolios. Now, in this second method, we're doing the same thing at the composite level. So you might think that this is a more accurate, maybe a more precise measure of performance of the composite because it considers the cash flows at both the individual performance level, the individual portfolio level, and the composite level, and you'd probably be accurate. But once again, the Institute doesn't ask us to decide, or they don't tell us which one of these to pick, but they ask us to decide. All right, so let's do the aggregate return method here, and there's the modified Dietz formula again. So all we're going to do is take a look at that far right column. So what do? We end up with 185.90. We subtract out the 150, and then we're going to go ahead and subtract out those cash flows. So take out the 10 for portfolio A, take out the 6 for portfolio B, then add back the 350 for portfolio B, and then there's nothing going on for portfolio C. And then we're going to divide by that beginning asset plus the weighted, which is the 160. So that far right column over there, this should make perfect sense as we're going through this. We're looking at this return on the composite as if the composite were just one security. So that's why we do all that stuff in the numerator. And we get, lo and behold, what is that number? 1461. What was this number? 1461. So the second and third methods are going to produce, almost a virtually identical number, because essentially what's happening here is we're just using the different ways of the distributive property of mathematics. All right, so that was a lot of fun, right? So let me just quickly remind you to be able to, let me go back as I'm reminding you, right? So we can do portfolio A, B, and C. We can compute the composite return in 3 different methods. So working through the math, you ought to be able to explain it. And then if the institute asks you to calculate it, well, then you ought to be able to calculate it. All right, let's go ahead and have this conversation about discretion and what it means. We have lots and lots of discretion. So what does it mean in the context of composite construction? We had discretion back in part 1 as far as those individual portfolios were concerned. Now we have, I think of it as kind of extra discretion. Now, what this means is how are we going to decide which portfolios to include and which ones to exclude? I mean, back in that previous example here, let me go back quickly here. We included A, B, and C. Maybe there was a D and an E that we excluded. Well, we need to have some good reasons. And so this is really common sense. The Institute says, look, you have discretion, which ones to put in, which ones to exclude. Well, just tell us why you did it. And if it's a reasonable decision process, then we're going to be okay with it. Now, remember, I say this regularly. What does the Institute want us to do? They want us to monitor. They want us to review. They want us to disclose. They want us to do all that kind of stuff. So that second box shouldn't be a surprise. A clearly written definition of discretion, which must be applied consistently. Now, we're always going to be faced with investment constraints. Clients are going to come to us and they're going to say something like, hey, you know what? You see that stuff over there? We don't want any part of that stuff. Or they're going to say over here, you see all this stuff over here? We want lots and lots of that stuff. So there are some examples there. Of course, you know these examples just as well as I do. Now, these client restrictions, they don't automatically render the portfolio as non-discretionary. The question then becomes, does that restriction, does that constraint materially impact the execution of the strategy? So here's a good slide to know, to answer that question. If the constraints have no material effect, well, then just put the portfolio in there. If they have a material effect, then you may or may not include the portfolio depending on what that materiality is. So look at that third block in there. What defines material is up to the discretion of each manager. So there are varying degrees of discretion. I mean, here's the example, and this one we use in the check mark. This is right out of the reading. Suppose the client says, you know what? I don't want you to use any option contracts, no matter what. And if your response to the client is, well, I know nothing about options and option pricing, which of course, that's not something that we could reasonably say after having been through the CFA program. But, suppose we say, well, we don't really want to use options. They're not going to add any value. That's not part of our strategy. Well, then, of course, what we can do is we can go ahead and say that restriction is not material. But if we're saying something like, you know what? I've watched all of Jim's videos. I've read all the CFA material. I know tons and tons about options, and I can use it not as the bulk of my portfolio, but I can use those options to add value, maximize end of period wealth. Well, then it's a big restriction, and it should be considered non-discretionary. Now, you also have to worry about cash flows here. So look at that first one. Yeah, patterns of external cash flows may render a portfolio non-discretionary. Suppose you have a client that has a $100,000 portfolio and then comes to you and says, hey, you know what? I want to build an $80,000 swimming pool in my backyard. And what I want you to do is I want you to sell 20,000, 20,000, 20,000, and 20,000. And I want you to do this over the next weekly basis. And so the portfolio used to be 100, now it's only 20. Well, that's probably non-discretionary. And then, of course, I said this earlier, you can't use simulation, you can't use model portfolios in the composite, because then what are you tempted to do? You're tempted to say, oh, this model worked really, really well. Let me throw that in there. This model stinks. Let me exclude that. But then, of course, and remember what I said back in part one, all of these LOSs relate back to the code of ethics. And so, including a modeled portfolio that does really well, boy, that's probably some violation of at least 3 of the 7 standards, right? All right, so here are a couple of good block points. This is taken directly out of the reading. So all actual fee-paying discretionary segregated accounts must be included in at least one composites. Yeah. Discretionary segregated accounts that are non-fee paying, they may be included, but we need to just tell them why we're including it. Pooled funds must be included. That makes sense. And a composite must include all portfolios that meet the composite definition. So that bottom 90-degree box, that's a really great exam question where the Institute gives you, a bunch of portfolios that are included in the composite, and then they'll give you a really good reason, or what sounds like a really good reason, to exclude this portfolio. Now, you may exclude it, for some reasonable outlines, but there are some that are not reasonable. All right, how about defining an investment strategy? Yeah, we've said this earlier, investment mandate, objective, or strategy, all of those portfolios that meet that definition of the mandate or the objective or the strategy, they must be included. And then we need to define what that definition is. All right, so here's the LOS on the hierarchy of defining composites. So just think about this as a pyramid. So we'll start with the investment mandate. There's an example, global equities. We'll then go to asset classes, so fixed income or equity. And then the style, large cap, mid cap, small cap. And then benchmarks. I say this so many times, the Institute is so big, and I've learned so much about benchmarking from just reading through the CFA Institute materials, and I convince my students in my investments class that the benchmark is super important. We want to make sure that we're comparing our performance against a reasonable benchmark. And my students, they want to say, well, Jim, why don't we just use the S&P 500 index? And I'm like, you know what? That's okay if your portfolio consists of the 500 market-weighted stocks inside of the S&P 500 index. But if they're not, you may have to create your own benchmark. So remember the benchmarking conversation here and how it has been shown to us back in level 1 and level 2. And then finally at the bottom, risk-return characteristics. All right, how about these GIPS standards with respect to composite construction? All right, so how are we going to get into the finer details of including or excluding portfolios? So look at that red box over there. Placed under the control of the manager. That makes perfect common sense, right? So look at the second box point. Must establish, document, and consistently apply. This goes back to what the Institute wants us to do in terms of reviewing and monitoring and evaluating, et cetera, et cetera. Look at the second block point. This is really a good example, and I'm going to call your attention to one of the problems at the end of this reading, where you're given in the question stem a bunch of dates, and you have to decide, does this portfolio is it included or excluded in the composite? So look at the example. Composite returns computed monthly, and the new portfolio is included on March 15th. What do you do? What do you do when you have control of that portfolio on March 15th? What do you do for the performance from March 15th to April 1st? Well, I guess you could go back and say, boy, it ought to be at the discretion. Well, that really doesn't make a whole lot of sense, because if we have great performance at the end of March, we might want to include it. If we have stinky performance, then we might want to exclude it. So what the Institute says is, you know what? You had control of it on the 15th. you just start on April 1st because the Institute says, look, you picked monthly returns, so you got to start at the beginning of the first full month. So that's what that one tells us too. Yeah, what if there is a delay in investing the assets? So this is where the discretion comes in. So we take control of the assets on March 15th, and we keep all of that in cash because the client says something like, you know what, I want you to hold on to this for some reason. So there might be a combination of taking control and discretion and client constraints. So you need to decide, what are we going to do? And you just need to decide what it is and then just apply it consistently. How about terminated portfolios? Go down to the blue diamond. Let's just work through that example. This will tell you exactly. All right, we calculate composite return monthly, pending termination on June 15th, but it's effective June 30th, and the portfolio should be included in the composite only up through May 31st. So that's a good standard there for terminated portfolios. Now, the Institute says, you know what? If you want to put if a portfolio is in this composite and you want to switch it over to this composite, well, you better have a good reason, right? So look at that first circle point. Requires that portfolios cannot be switched, right? Unless there's a documented change in what we've been talking about all along. The mandate, the strategy, or the objective that makes it appropriate. Once again, the Institute says, look, if it's reasonable to switch composites, then go ahead and do it. Just tell us about it. How about a temporary removal of a portfolio from a composite? Well, this will almost always be to the occurrence of a significant cash flow. Let me go back to that example that I said earlier with the $100,000 portfolio and the swimming pool in the backyard. You might just want to remove that because it used to be $100,000. Now it's only $20,000 because of that large, significant cash outflow. We're going to go ahead and wait until that client then contributes enough capital to get it up to, well, we'd have to pick a number, $70,000, $80,000, $90,000. I mean, whatever that number is, we just need to apply it consistently. How about minimum asset levels? Clearly on that last slide, if we have a minimum asset level of 100,000 and we go down to 20,000 because of the swimming pool, well, then that's going to apply and that's going to say, okay, we're going to remove that. But suppose that we just have a stock market crash or we have some other non-cash flow related dipping below a stated level. And so these three boxes here, go ahead and explain those. How about reporting requirements? Reasonable effort to provide a GIPS report to all prospective clients. I think we talked about that back in part 1. GIPS composite report and the GIPS pooled fund report. Yeah, so it should cover all this material that we're covering here for specific composites and for specific pooled funds. All right, let's head into the end of this here. Requirements and recommendations for GIPS composites. All right, so minimum years of performance. I said this at the beginning of part 1. You know, we want to show at least 5 years, and then we want to go ahead and put in 6 and then 7 and 8 all the way up until 10. If we haven't been in existence for 5 years, then you just build these up starting in year 1 and 2 and 3 and 4. You don't have to wait till year 5, but since inception. Required elements, so we want the composite and the benchmark. We want the number of portfolios. It's 6 or more. Boy, you know, try to remember that. Somehow you can remember 6. Boy, I'm really struggling to think of would the Institute give you a 5 and a 6 and a 7 and ask you to distinguish between those? They might. Amount of assets in the composite, total firm assets. And this is where it gets a little bit interesting. We have a couple of slides here coming up. 3-year annualized ex post standard deviation of the composite and the benchmark. And then some measure of internal dispersion. So here's where it gets a little bit interesting. You know, what are internal dispersion measures? Well, we can do a high-low method. We can do the range. We can do an equally weighted standard deviation. We can do an asset weighted standard deviation. And so what does this do? Here, let me go back here. Oh, where was I? I was right here. So look at the purple teardrop point. 3-year annualized ex post standard deviation of the composite and the benchmark. All right, so that's required. And then internally, we get to pick high-low, range, standard deviation, equally weighted, or asset weighted standard deviation. And so this is going to add some extra value to clients and prospective clients. Yeah, GIPS standards do not limit using just one of these. Go ahead and present all of them if you want to. But the GIPS standards require that we're expressing this information regarding the historical variability. So that's really the goal of this part of the standard. We want to say something like, all right, we did all that work to compute the composite return. All right, so given that number, what was it back in our example, 14.6 or 15, whatever that was, then we need to give all of our investors and potential investors an idea of the risk, right? So that's why we use standard deviation and all these other methods to try to signal to the marketplace what is the risk so that our potential clients can make a comparison. Remember, I want you to think about this from the very first days of level 1. That return, that's the first moment of the distribution, and then the standard deviation or some measure of variability is the second moment of the distribution. And so we're just trying to give these clients and potential clients a sense of our variability. All right, how do we link past performance? Well, we talked about this back in part 1. What did I say to you in that part 1? This is probably going to be the result of 2 investment firms merging or one larger investment firm taking over another investment firm. Recall I gave you the example of you guys being a big old fund and I'm a little fund and you take over my assets. So if all of the decision makers are significantly employed by the new or acquiring firm, then you have to include it. There's the word substantially. Remember back in part 1, several times in the reading, the Institute uses the word substantially, and I was questioning what does substantial mean? Well, it means, whatever you want it to mean from your discretion, but it can't mean 2 out of 13 employees or decision-making process. Yeah, the newer or the acquiring firm possesses records, right, that document and report the supported performance. No break in the track record, right? You can't take over my company and say, oh, you know what, Jim, he really stunk, and so I don't want to include those last years. But boy, 2 years ago he did a great job. Yeah, you can't do that. All right, remember the Institute recommends but does not require verification. So there are super cool exam questions on what it means to verify. So let's work through a couple of these slides here. What is verification? So we ask somebody over there, an independent third-party expert that knows everything there is to know about the requirements for the GIPS standards. What this is going to do is that going to say to the marketplace, hey, there's greater confidence in all of our claims of compliance and all the stuff that we're presenting. How about the benefits of verification? These are obvious notions here: gain credibility, increase knowledge of the performance measurement team. That's a really good one because we did all that work to compute the composite return. Well, that increases our knowledge base, and that has to be a good thing. Consistent, higher quality performance presentations, right? Improve internal processes and procedures. The Institute, as you know, is very big on internal processes and procedures. Now, what this verification does then is that it signals the marketplace that, hey, we have these internal processes and these procedures in place, and they are compliant with all of the GIPS standards. And as we learn more and more about all of our portfolios and as the assets under management grow, well, then we can improve our internal processes and procedures. All right, what about the scope? Qualified and independent third party. A verifier must perform verification according to the GIPS standards for verifiers, right? A verifier can't come in and say, oh, that looks good. Here's my signature at the bottom of the page. The verifier must, of course, know about these verification standards. Now, there's a really good question here. The single report based on the entire firm. It can't be just on this composite. It can't be just on this portfolio. It can't be just this investment manager. It cannot be done on a single composite or a pooled fund. If a firm fails to meet all requirements, then it may not claim compliance. That makes perfect sense, right? Verification process here, planning, sample selection, and testing. And so I'm not sure if this is a really good exam question, but it's something that I would know going into the exam, right? We're doing this on a firm-wide basis. So as a verifier, we don't have to go in and look at every individual security inside every portfolio, inside every composite. So we'll have to do some sampling, and we learned about that sampling back in level 1. Yeah, for the planning component of this, the verifier should know about the operations of the investment firm, its structure, its policies, its procedures, all that good stuff. This is what I was saying just a moment ago. Utilize a sampling methodology that we learned back in level 1. So when sampling, we need to consider number of composites, total assets, number of years, all that kind of good stuff. Testing procedures, record keeping, policies and procedures, definition of the firm. So the verifier is going to take a look at all of these things and make sure that the investment firm has defined these properly, is keeping good records, all that good stuff. Yeah, look at that bottom block point there. Verifiers must determine whether portfolio holdings, income, and cash flows used in calculating returns are evidenced by documentation from independent parties, such as brokerage statements. Of course, the verifier is going to say, all right, where's your data? Where's your record keeping? And then do you get some help from over here? Verifiers must determine that the firm has computed and presented performance according to GIPS standards. They'll recalculate rates of return for selected portfolios and composites. Not all of them, but they'll recalculate those rates of return. They must test the construction and maintenance of the composites, test whether the portfolios with the same investment mandate, objective, or strategy are incorporated in the same composite. Verifiers must test the sample of GIPS reports, and accuracy. That makes all sense there. Analyze a sample of the marketing materials to verify that those things are consistent with all of what the verification process has determined. So there we go. This was the end of part 2. So we did part 1 and part 2. What I want you to do now is go look at those 23 questions, set aside, maybe 46 minutes or so, work through all those problems. And I've gone through those, and we've covered, I'm pretty sure we've covered every one of those. So that ought to give you a really good sense of what the Institute is thinking when they create those exam questions. So thanks for watching. Have a great day and good luck studying.